Hey, we're live. It's Monday, June 1st. Welcome to Robinhood's monthly market update. I'm Michael Obucina, joined as always by Robinhood's Chief Investment Officer, Steph Guild. Happy Monday, Steph. How you doing?
I'm good. I'm happy because weather's kind of more consistently nice here in New York
Summer,
now.
summer's starting to show its head. We're getting pretty good weather here in the Midwest and Chicago. Hello to all of our friends in the chat. I see some familiar names. Quantum Queso Dip wondering what happened to the chill tunes from the week that was. Remember that intro music that we always bobbed our head to. We also got
A little
Felipe.
different today.
Yeah, we got Felipe in the chat. A lot of new names. Everyone, hello, welcome. If you're new, first time, don't forget subscribe to the channel so you can comment in the YouTube chat. We do take your questions live. We'll do that later in the show, and we like to, just have fun, go back and forth with you guys. Steph, let's get right to it. We got a lot to do today. Here's what's on tap. We are talking, well, the state of the markets, but really this AI trade, like how much further can it go? Plus, we're very excited. We bring in a guest to these monthly market updates. We're going to be joined today by special guest Katie Stockton, who is the founder and managing partner of Fairlead Strategies. Katie is a chartered market technician and one of the most respected technical analysts on Wall Street. So it's going to be a heavy chart day, folks. She's going to be breaking down the charts, looking at key levels, and then we're going to take a technical look at some of the more traded stocks in the last week at Robinhood. So the top 3 buys, top 3 sells here at Robinhood. We'll be looking at those. And of course, we're taking your questions. So once again, subscribe to the channel. Get those questions in early and often, and we'll get them on screen and answer them later in the show. But before we get started, as always, some ground rules. Today's content is provided for informational and educational purposes only, does not constitute tax or investment advice, and is not a recommendation for any security or strategy. Remember, all investments involve risk, including the possible loss of capital, so please consider your investment objectives and risks carefully before investing. Past performance does not guarantee future results, and last but certainly not least, this live stream is not an official customer support channel, so if you have questions about your account, reach out to our support teams from within the app. They're ready and waiting to help you out. With that, Steph, and there's a little familiar music we remember. There's a lot to jump in, a lot to get to, so let's jump in. I'm going to set the stage for you, Steph. One of my favorite things you do internally at Robinhood is you do a monthly market update at our sort of company all-hands
Been
meetings.
a little more like quarterly, but yeah.
Yeah, quarterly. Yeah, it feels monthly, but yeah, quarterly.
Yeah.
And you used to summarize the entire market with what you called your coffee cup tracings, which were just simple hand-drawn sketches and just a very simple visual that made everything click for us. Well, those days are gone because
Yeah.
AI has
You don't have
entered.
to draw it anymore.
No, you just tell your favorite AI engine what you want to see. Now, what started as coffee cup tracings has evolved into full-blown AI-generated, I guess, masterpieces, we'll call them. I'm not worried yet, but the one that we have coming up here in a second, it just feels like we're inching towards the singularity between your mind and AI in the market. So this is the one you did in January. Briefly sort of explain what was happening at the start of the year, and then we'll show off the current one, which frankly gave me a little bit of the Lord of the Rings vibe.
This one, I sort of was I asked it to be graffiti-like, just because I think graffiti is cool. And I kind of was thinking about 4 major themes. One was just increased spending and investing aligned with fiscal policy. And then that was that sort of upper left-hand chart. And, all this increased defense spending as well, which we've seen play out. Defense spending itself has kind of not been a theme more recently, but it was kind of top of mind at the very start of my year and towards the end of last year. On the right-hand side was sort of the cost of things going up, the dollar being it was pretty weak previously, bread, eggs costing more, if you remember all of that stuff, and rates likely being higher, which we have seen. On the lower left hand was also just the cost of living being, and what is happening to the savings rate. At the time, the savings rate wasn't really weak, but I was nervous about that, and it has actually started to come down. And on the right-hand side was obviously building out of data centers and AI and humanoids and the kind of combination. It sort of, I asked it to put in gold and silver and basic materials, which it kind of fit in there, but not great. So that was what I was thinking about at the time. And I have since taken my most recent kind of set of talking points that I bring to media, and I gave it to AI, and I actually gave it to 3 different LLMs. And I have to say, like, Anthropic or Claude, Mr. Claude, he does a good job with analysis and spreadsheets and things like that, but he is not good at drawing.
Sounds like me. I was never good in art class. I was good in accounting, not good in art.
Gemini also was not great, but ChatGPT really did an amazing job.
I just saw a commercial last night, ChatGPT doing like graphic artist stuff, but let's bring up. So first off, Edsman, I finally saw. I was worried I didn't see Edsman in the chat. How you doing, boss?
Hey, Edsman.
We got Luox. Oh, all the old favorites are here. But this next one, like I said, gives me the Lord of the Rings vibe. Like we start in the Shire down at the bottom, we go to the 2 towers, then we're in Mordor. Like there's a lot here. Sum it up for us to kind of take us through the current state of the markets.
A lot of detail.
Yeah.
It's probably too much detail to go through. I mean, I literally fed it. I fed it all my talking points and like all the little details that I kind of keep to myself that like I'll use in my back pocket if I need to, have a data point or something. Anyone who's been listening to us for the last like couple of years, one of my phrases that will never die is expectations are everything, and that's at the top. Expectations were pretty high going into Q1 earnings, and they still beat. Now some companies had really high earning expectations and they beat by a little bit, and that wasn't enough. But the AI kind of mid and small cap high flyers just had fantastic results. And you see like in 1 month's time, some of the names are up 50, 100, 150%. And so my concern is just like they're priced for perfection. It doesn't mean they can't continue to go up because we've seen it over time in history, over decades, that stocks can continue to move higher against any fundamentals. But I'm starting to be a little neutral on them. So I'm not saying that you go and sell all of the things that have worked really well in your portfolio, but I am kind of starting to say like maybe you take a couple chips off the table. It looks much more ominous, and ChatGPT really took that far on the left-hand side. And one of the reasons why I say that is like, what if, something causes the spending cycle to temporarily decelerate, or there are delays, and you are starting to hear that in some of the earnings, like they have to rethink their margins because the cost of memory is higher, the cost of computing is higher, or you're just hearing delays in data centers because the physical world cannot keep up with the agentic world. Yeah. And so that is credit tightening, like there's more bond supply from the hyperscalers now than there ever has been. What if boards are just like, you got to keep margins up, and so this is just why I say like it's always good to keep, take it maybe a couple chips off the table. That's sort of part of my talking points. On the right-hand side, there's short interest on the rise, and this is a piece I actually put out last week in Investors Guild, but across the S&P 500, short interest is 3% of market cap, was actually the highest level since 2011, which in 2011, we were still kind of licking our wounds from 2008. So, and biggest increases we're in the software space. So I actually think that's almost like helpful for the software space. People are starting to get less negative on it. And I do think it's like selective. It's not across, but, I do think that that's causing some short squeezes. And it means that, I think some of those names could go higher. Energy is the one place shorts have been decreasing. And that is a place that, I do think is underappreciated. And even the defensive sectors, have seen short interest increase on the right-hand side. And actually, healthcare is at a 30-year high. Again, I think it's another place that you can find opportunity. And then inflation, it's kind of related to the energy sector, but it was already turning up before the Middle East conflict. Like the ECRI, which is like an economic indicator group, was flagging this at the end of last year, flagging it in January. And one of the things I think is most interesting, and again, this is like the physical world is going to have a hard time keeping up with the agentic world. And this is my last point, is that transportation prices, between that and capacity of transportation in the logistics managers index in April of 2026, the spread was 67 points. So transportation prices up 95, capacity down to 28. That's literally never been seen before in this index and its history. So I do think inflation is here to stay, at least for a while, and that coupled with high supply of debt in everywhere, it's unlikely, I think, to see interest rates go down materially.
Yeah, and looking at the prediction markets, number of Fed cuts in 2026 has dramatically dropped. We have two cuts trading at 6 cents, one cut trading at 15 cents, and exactly zero cuts trading at 68 cents. Meanwhile, the prices for rate hikes starting to creep up.
Yeah.
So, the ground shifting, we do these now monthly, and it seems like, just that 4 weeks, everything sort of changes from a narrative perspective. Obviously, AI driving the big moves right now, and I think this is where we're going to go with Katie for a little bit, is how much more room is there? Do we expect sort of a sideways summer? Is there going to be a point where you start positioning things for, that less of a move up and more of just sort of a chop and maybe a little bit of a correction? So with that, though, I do want to bring on our special guest for today. Let's welcome in Katie Stockton, founder, managing partner of Fairlead Strategies. If you watch TV enough, CNBC, other financial outlets, you probably have seen Katie. She's a chartered market technician from Fairlead Strategies. Katie, welcome to the show. How are you?
I'm great. How are you?
Good, good. Before we get into the charts, I want to just tell everyone about what a CMT is. We're in a world now where there's a million YouTube channels and everyone is typically showing off charts, and there's almost a new language within the technician space. But when you see someone with that CMT designation next to their name, what does that represent in terms of their knowledge, their abilities, their experience? Tell us about that.
Well, it's really a credentialing program. So it shows that you've put in the work. In fact, 3 years of work is required to achieve this CMT typically, because you need to take 3 exams. It's very much like a CFA or chartered financial analyst in that, there's a course of study and there's online tutorials, things of that nature. So you really learn a whole lot about technical analysis through this program. For even folks that are not interested in the credentials of CMT or chartered market technician, would be probably interested in the education that they can derive from it. But once that 3rd level is complete and you have your mentors sponsoring you, you can achieve the CMT, which I received in 2001. At the time, I was the youngest female to receive it. I can't say that any longer, of course, but it's really helped me throughout my career.
Nice. And we're gonna show off a handful of charts. So let's bring up the first one. We've got the S&P 500. This is a daily chart. Before we dig into the analysis, talk to us about your setup. There's always the debate: how many indicators, what types of indicators, and there's a variety of different stochastics and MACDs and relative strengths, and every sort of technician has a different sort of way to go about it. But what are some of the core principles in the way you set up your charts, and what is some advice you can give to an aspiring technician for sort of filtering down to the core signals and what might be more important than others?
You can see by the chart that I use a lot of indicators, and they're definitely helpful to us in terms of our process. But by no means should anybody be intimidated. It can really be much simpler even than this, and just price and moving averages, and you're still deriving value from the charts. We like to categorize technical indicators 3 ways: as either momentum, trend following based, overbought, oversold, and relative performance inputs. All of those can be really helpful in terms of decision making, whether it's just putting on a trade, whether it's making a long-term investment. And managing risk, of course, is a really great takeaway from the charts. These are great charts, by the way, so they look really good. So the tools that are at your disposal here, you're seeing moving averages, you're seeing the Ichimoku cloud, that's the shaded area on the chart, that's a trend following metric. You see also in the middle window, the stochastic oscillator, that's something we use for that overbought, oversold input. And then also the MACD, which is another sort of momentum gauge and can be really helpful when trying to discern if the trend is tiring out.
Yeah, and moving averages, you have just the standard sort of 20, 50, 200. So 20-day in the blue, 50-day in the orange, and the 200-day in the white, all upward sloping in unison, which is definitely a bullish signal. Like you don't need those moving averages to tell we've been in an uptrend. I think Ichimoku is one. There's a lot of guys here in the office that use it. I don't, but I always want to learn sort of how it works. You've taken off some of the additional indicators there, so you just have the cloud. But it's something I've heard over my career. Having a stochastic, having a MACD helps with momentum, trend reversals. With that, let's jump into SPX. We clearly, from the lows back in March, have been in a strong, solid uptrend. What do you want to cover here first? What's the story that SPX or the S&P 500 is telling us at the moment?
But I think we can start with the moving averages because they are, of course, all pointing higher. Importantly, that 20-day moving average is the most sensitive one that we're showing there. And we don't always focus on it, but when the market's in a steep uptrend like this, we do focus on it quite a bit because it can help us understand when a correction is ensuing that's significant enough to reposition around. Once the 20-day moving average starts to roll over, we feel that that's a risk metric. It's a good time to maybe pare back some of the higher beta exposure. It's still pointing higher right now, so that's a good thing. We have an overbought reading in the stochastic oscillator, but it recently turned up in what we call a bullish pop. So as long as the stochastics hold up or around that 80% threshold, we're fine with that. It's when they start going down and pointing lower more decisively that we take issue with that as sort of an overbought indication or overbought sell signal. And then the momentum whipsawed during the brief consolidation period, but is now whipsawing higher, we believe. So we want to just honor the momentum there according to the MACDs, which look even better on the weekly and on the monthly charts of the S&P 500. So the daily is giving you more of a short-term takeaway, whereas the intermediate and long-term takeaways can be from zooming out and looking at the weekly and monthly data. So we want to honor this trend, even if at times it feels like it's a bit overstretched. We're also seeing flag patterns, and there's one denoted on the chart here, where it's a steep up move followed by a consolidation period that is then resolved higher. Those have been extremely common in the semiconductor sector and even beyond in sort of legacy technology type holdings like Dell most recently. So we believe these flag patterns can foster upside follow through. But with all of this in mind, because the uptrend is so steep, it of course means that it's somewhat stretched from initial support. So even just using that 50-day moving average in orange, I think this morning it was about 7% below current levels. So there needs to be some attention to risk management with that in mind.
So like from a trading perspective, if you're looking to position around, so it sounds to me like short term, there's still potentially some movement up, but maybe medium, neutral, long term, kind of we might see a neutral or correction. Is this a good time to maybe consider a strategy like covered calls or something to sort of create some downside protection, maybe putting on a collar? Like, how do you translate that into potentially a positioning for a trader or an investor?
Yeah, I would think you'd have to consider that within your overall portfolio, how to go about that sort of hedging. I don't think with the momentum so strong that there needs to be an undue amount of hedging right now. But once the momentum does start to falter, that's where we would consider some reduction in exposure. For some people, that might mean, okay, well, raising some cash in their portfolios. Others, it might use derivatives strategies. So that's really less important than the momentum itself. The momentum gauges can help, in a way, manage risk by responding to the environment. So rather than anticipating that downdraft, we want to react to a loss of momentum. We think it's more likely in the summer months, sort of more in the heart of the summer, that we'll see a correction that is significant. And with that in mind, we are definitely watching those short-term indicators really very closely for that risk indicator of a correction, but we just don't have it yet.
Got it. Let's move to the story of the last 2 months, which has been the tech sector. We're going to go over to the NDX weekly chart. This is the NASDAQ 100 index. What are some of the takeaways? We obviously know the AI trade is moving things and is sitting below the market there as sort of kind of the, I don't know, Steph, would you call it like the market's put at this moment? Or, is this more like are we getting out over our skis a bit? It seems to be the conversation everyone's talking about at the moment.
Feels like it. I don't know. I feel like I'm starting to see a rotation within where, and I don't know if it's just like me being influenced by reading X and other spaces, but if you're looking, you're starting to see, as I said, software starting to move a little bit better and not have so much negative momentum, at least in pockets of it. And you're starting to see some older school, I say old school, like tech, like obviously you've seen Dell move up higher. They had high expectations going into their earnings call and they crushed them. And then, IBM is also kind of following nicely. And you're starting to see like IBM is almost like a good picture for like what's happening across the space because it doesn't just supply one thing or do one thing. So I actually think like it's still alive and well, but it's probably like everything in this market moving fast and starting to shift, in my opinion.
Katie, we've got the weekly of the NDX up. One thing I see a lot with retail traders is they tend to skew short term on their charts, but zooming out to a weekly chart, what are we taking away from the NDX? We've got a former resistance line drawn here. This chart's going back, we got at least 6-7 years. And the moving average is the 10-week moving average. How do you use the longer term charts and what are you seeing in this picture?
Well, when we look at multiple time frames sort of all at once, so whenever we pull up a security, we look at the monthly, weekly, and the daily charts. The monthly will give us a sense of the prevailing secular trend and any signs of exhaustion in that trend. The weekly is more about the cyclical trend, which of course with the NASDAQ 100 you can see is very much to the upside. That breakout above former resistance was a positive catalyst. And that it's a good point to bring up because we have seen a lot of breakouts, especially within technology in this environment, and breakouts are actionable. So even when something feels a bit overstretched, maybe, and it clears a resistance level, that is a positive catalyst because it means that that supply at that level has been removed or just isn't there anymore for the market. So whenever you see a breakout, that's something to honor either as an opportunity or as a risk input. And of course, this breakout now is a bit old news, but very good follow through on the back of that. This is also a very good example of the cloud model. You can see that the last major corrective phases have brought the NASDAQ 100 into that cloud-based support level. When we're looking at charts, we're always looking for these key levels, support and resistance, support being an area of buying pressure and resistance an area of selling pressure. There's no resistance for the S&P or for the NASDAQ 100 because they're at new all-time highs. And support levels are a little uncomfortably far below. We're watching right now either the 50-day moving averages, which is sort of estimated here by the 10-week moving average, and or those former resistance levels as our primary support gauges. And that's why, of course, some attention to these short-term momentum gauges is really important.
Can I just ask a question about the cloud?
Of course.
Where you're like, I see where you're talking about where the resistance kind of touches the cloud. Is that like, I look at that and I think like, oh, it was very, like you could have seen that, but you probably didn't have very much time to action it. And then in the moment before it starts to pop and break out, is that something that you, like, I also would be like, oh, I got to watch to see if it like breaks through, or is it kind of like very low probability that it ever breaks through that cloud?
Well, so we use a mechanism to determine whether a breakout or a breakdown is confirmed or more decisive. And it's really very simple. It's just waiting for two closes above or below a certain level. So on this weekly chart, it would be two weekly closes below. The cloud would have been a breakdown and vice versa. So that's just a way to eliminate whipsaws and
Right.
shakeouts, things that are like false, right? False breakouts, false
Yeah.
breakdowns. It's not perfect by any stretch. But with these trend following gauges, they're always going to have a lag to them. Their design is to reduce noise in the marketplace. So they definitely achieve that. The cloud right now is pointing higher. It's acting as a potential support gauge for the next correction, not relevant at this moment. But it does remind us of the prevailing trend just by the nature of being below price and pointing higher. And once we see those indications of a correction, well, then we can consult the cloud for a support level.
What I love about this chart, this is a perfect example of a confluence of indicators lining up. So if you are a technician, if you are trading on the technicals, one indicator, okay, two, yay, three, like, okay, now we're getting some momentum. And as a trader or a longer term investor, the more those stack up, the more confidence you could potentially have to increase your trade size, tighten your risk. Like once again, there's no prediction element here. It's more about probabilities. And in this case, right, we've got the base and breakout. Steph and everyone in the chat, you're familiar. We talked about bases and breakouts with our good friend John Roque from 22V. This is a great example of a base and a breakout, but then you combine it with, trading below a moving average, then getting back above it. You've got the cloud, you've got a oversold indicator, and you've got a MACD turning around. And this is on a weekly chart. So these are much longer, times in terms for these setups to establish themselves. So for someone that's maybe a longer term investor, you still can use technicals as a way to find those areas of opportunity. Let's move to the small caps because here's one, that's kind of getting lost, I would say, in the mix relative to all the AI names. But here's one. We have a former resistance now looking to become support. And you've got the moving average, which here is, what do we have, a 12. This is a monthly chart. So each candle represents a month of data. Here you've got a 12-month moving average as support. We're above the cloud. I mean, explain what's happening in small caps, Katie, and what this chart is telling you.
Well, I like this chart a lot because it's different than the S&P 500 and NASDAQ 100. It's not as overstretched in its appearance on the monthly, and it has the more recent catalyst here of a big breakout, right? It was almost a cup and handle formation. You might have heard of that, which is essentially a rounded base followed by a corrective phase that then gives way to a breakout. So that we have this big cup and handle breakout by the Russell 2000 index. And with that, the indicators have newer upturns than, of course, we've seen from the S&P 500 or anything that's already had such a strong run. So you can arrive at impressive upside objectives from these types of breakouts. And I think it's a good bullish long-term backdrop that we have, or we can take away from this chart for the small cap complex, which has done sort of relatively well or better this year than last year at least. So you can make a case for it. But in this area, of course, stock selection is that much more important because you have some big time winners, big time losers. But overall, the small cap complex definitely looks compelling longer term. Shorter term, there's actually an overbought downturn that suggests that we'll see some consolidation. So that means with new purchases, there's no rush necessarily to add exposure, maybe give it a week or two to consolidate, and then you can take advantage of it. So in a way, we're using that long-term picture on the monthly to help guide our positioning on a short-term basis.
Nice. All right, let's move to some sectors. Two that caught our eye in the report you sent us. XLK. We've got a weekly chart here. Obviously, this is going to encompass a lot of the tech names. What a beautiful setup here back in March 30th, going right off the top of the cloud. And this is another setup, Katie, I like to look for, maybe more on some shorter to medium term charts when I'm trading futures, but what I call and others call kind of moving average fakeouts, where you get a break of the moving average, and then you look to establish a position when it reclaims that moving average, and then you put your sort of risk or stop below that recent low. Here's another one where you have multiple indicators lining up between the cloud, an oversold condition, and then a turn in the MACD, and then bam, we get that rally up in the tech space. What's XLK showing, and how much is this getting frothy?
Yeah, I mean, just visually, it looks quite steep, doesn't it?
Yeah.
But it's very much the same takeaway as with the NASDAQ 100. The indicators still point higher for now. You can see that probably best in that MACD histogram. So the MACD stands for Moving Average Convergence Divergence, and the MACD, it's based on a spread between two moving averages of price. And the spread between those two lines that it takes away creates the histogram. And as long as it's ticking up as it has done, we feel pretty good about the momentum behind that up move. So we're on board with the tech sector on the back of its breakout. It's still showing that momentum. We have still some catalysts in the works, both technically and potentially fundamentally. I know Broadcom's reporting this week. So, we're on board with it still, but very sensitive, as mentioned, to the short-term indicators, just watching for any downturns. It can be as simple as watching either for that downtick in the histogram or watching maybe the daily MACD for another whipsaw lower.
Yeah, and then the other sector we were looking at is the comms sector. Let me switch that over. XLC. Here's one where you're going to get some of those big names. What we got? Meta. What are some other those names in there? This looks to almost be kind of trading sideways, going back to, let's see. This is a what do we have here? A weekly chart. This is a 40-week moving average. Starting to see some sideways consolidation at these levels. What's the story that we're getting from the comm sector?
Well, I think the story is that not everything looks like the tech sector because this is a very different setup, isn't it? We've seen consolidation, sort of a range-bound action, still within the context of an uptrend, as denoted by the cloud model. So we're just more neutral in the status of this chart, but naturally a breakout to new highs would act as a positive catalyst. We are seeing some signs of life in some of these names, including Meta, which had really been under pressure and underperforming. But a breakout is needed here, I think, for a positive catalyst to warrant new exposure. It doesn't mean, the existing exposure needs to be brought down necessarily, but you can just see the loss of momentum within the context of that longer term uptrend. And we'd be watching support levels and the momentum gauges on the individual stock level, as with tech.
To the chat, Paul Ocampo is asking, what's the cloud we keep referring to? That's the Ichimoku cloud. It's a study you can access on Robinhood Legend. For people that are unfamiliar with Ichimoku, because I feel like it's a very passionate community that uses Ichimoku, and everyone that I see is always trying to explain to me, like, you got to have this on your chart. Elevator pitch. What is Ichimoku? What is it measuring? And what is sort of the shape and direction telling you as you look at these charts?
Yeah, I mean, think of it almost like the MACD indicator because that's a much more familiar indicator, but now it's on the price chart itself, and it's on the price chart with a forward-looking shift. You can see it extends ahead of price, and that's a very unique quality of it. So it's derived not from moving averages, but rather from midpoints of price. So it's taking a high-low spread over various time frames and using that as a basis for its calculation, the midpoint of that spread. And that's why it gets that kind of jagged look. It's more plateaus versus a smooth moving average. But the messaging is twofold. One, it's what's the prevailing trend. So when price is above, that's an uptrend, and vice versa. It does lose some, validity in range-bound environments, depending on the time frame. So just like a MACD, which will start whipping around and flashing more sell signals than are helpful, that can kind of happen with the cloud model as well. But think of it as a gauge of the prevailing trend in a trending environment, and then also a gauge of support or resistance. So if price is above, It's a prospective support level. You can see it worked very well for XLC on this chart here. Each of the corrective phases held near the upper boundary, and that just suggests that the trend is still healthy. Now, if we were to see a breakdown below the lower boundary, that would be, of course, a negative catalyst. Ideally, we wouldn't have to wait for that breakdown before seeing some risk in our indicators, but that affirms essentially that a reversal has occurred. And you can see that that happened, ahead of 2022's bear cycle.
Yeah, and I think this is an advantage to taking a longer lens view of something where you may not, to use your term earlier, get shaken out or get whipsawed. Here's where you're breaking down below both the moving average and the cloud. You're testing it, and then the moving average holds, trades through. So it's like, as a trader or investor, where are you looking at a potential entry point? It's like when you get a retest of that, and then there's maybe your possible entry point. And then as thinking about risk management, like where would I want to give myself some room to be wrong? It's like you could almost use the cloud as a way to trail up a stop, or if you're using options, kind of use those levels as kind of where you get out. And here, none of that. You would never have gotten threatened on this position if you got long this sector back in October 23. So once again, simplifying your approach, but looking for kind of a confluence of indicators. We got some questions piling up, so we're going to get to those soon. But really quick, let's go through the lightning round. We got oil. Steph, we thought we were out of the woods with Iran, but apparently negotiations are off. They're on, they're off. There's a ceasefire. There's not a ceasefire. What's going on in oil right now? And then Katie will have you walk us through the chart.
Well, it's obviously, like you said, it's back and forth. I think the market wants to just assume that it's going to be okay, which is probably true in the longer term. But the amount of time that we've had from the end of February to now, where there's a lack of supply, and everything that I've read, it's been that we've essentially been using inventories to supplement the differences between what would have normally been produced and what would have been demanded, and that is looking a little bit like demand destruction in some places, but it's not. It's just like supply destruction. So they're just using inventories, particularly in China. And that's, I think the longer that goes on, just the more, it just makes for potential shortages that causes inflation to go higher once we do come out of this. And that's something that I am nervous about.
Yeah, and having traded a little bit of the oil market recently, it's been a tough trade because it's so news driven at this point, which creates an X factor as a trader that you don't tend to like. Like one of my favorite periods to trade, for example, in the S&P 500 is between earnings cycles. It's just sort of this, Steph, you call it the period when your significant other goes away and they haven't texted in a while.
They haven't texted you back. Yeah.
Yeah. And you're like, oh, what's going on? But that's a great trading environment where now you could be in a position, something, hits the news wire and oil's up or down. Like today's a good example. We've got the news out of Iran that the ceasefire's off, and then oil has rallied back up. Last I checked, we're trading at 93.36 on the futures contract. Katie, we've got the chart of oil up on the daily. Looks like we've got a range of, we'll call it 76 to 110, give or take. And some kind of big swings and consolidation after that big move up initially on the news. We had Bob Iacino on the March or April market update that we did, and we asked him, is the high in for oil at 120? Do you think the high's in for oil, or what might you be looking at from the charts for oil?
Well, it's a short-term high for sure, but the longer-term indicators that we track have shifted to the upside, and this actually happened ahead of the conflict. So this happened in February, that we saw that MACD indicator cross over on the monthly to suggest there's more at work here than simply, the conflict, right? The volatility is obviously a function of that, but the turnaround, we think, is the function of a commodity bull cycle. And in a way, there's opportunity here, but there's also risk here, and they do often go hand in hand. I think the opportunity is the volatility, and the short term, you can see the swings are pretty decisive, and that daily stochastic oscillator has been very helpful in identifying the directional bias that's appropriate from a very short-term perspective. So we're seeing an oversold bounce right now. The cloud suggests that some support has been broken, short-term support, and so that would tell us that maybe we'll see another lower high within this kind of range-bound environment that's ensued since the original turning point higher for crude oil. So short-term volatility that can be leveraged in your positioning, but the risk here is greater and long-term, I think, for the equity market. When you look at past spikes or shocks in the price of crude oil, they rarely are a good thing for the market, as you could imagine. And so we are sort of bracing ourselves for more volatility in equities, in part because of this shock that we've seen in the price of crude oil. But for those that are trading it, this volatility can certainly present some opportunity.
Yeah, we've got the 20 and 50 day starting what I like to call they're confused. They're sideways. They're not sloping in unison. They're crossing over. Could this be a potential area as a trader you look to fade if we continue getting good news out of the Middle East, or if we get back above this, will it sort of sit on those moving averages and try to retest that 109 level? Interesting spot because you're kind of in the middle of the range, and I hate trading anything when it's sitting in the middle of a range between sort of this 110 and 80. Lightning round, and then we'll go to questions. We've got over the last week, the top 3 stocks bought at Robinhood and the top 3 stocks sold at Robinhood. We'll do it on the daily chart. The first one, no surprise, NVIDIA. We'll go through these quickly. Katie, what do we have from NVIDIA? Some news hit the tape today that they're getting into kind of a new market in the PC market.
NVIDIA, obviously a long-term uptrend. It was range bound for some time, but advanced from that range. On the weekly chart, it's above the cloud. New highs were logged recently with that breakout. But then we saw a pullback more recently, and the pullback took it basically back to that breakout point, which was around 212. And now we have a short-term oversold upturn, which is pretty compelling as we get into this earnings report from Broadcom. So we're compelled by this setup right now, long-term uptrend, short-term oversold within that context, and a relatively recent breakout.
Yeah, potential here to hold the 20-day moving average. And if you think we're going to race back to new highs and make a new high, possible entry point for a bullish trader. Second stock, no surprise on this one. Can't turn on TV without hearing a discussion about it. Micron going purely parabolic. What do you do as a technician I call it when you get out into open water? It's like the Jaws movie when they're on the orca and they can't see land anymore. Like, how do you create levels to trade off of, manage your risk?
This one is just wild. It's hard. Yeah.
I mean, what I would say with this type of setup, right, we do watch the 20-day moving average, and you can see it's still pointing higher. And that was helpful even throughout the last corrective phase. So I would keep the 20-day on your side for one. And then we use the term watch the gap. So when you see gaps up like this within prolonged or steep uptrends, they can be helpful as gauges of support or ways to manage risk by placing a stop loss where that gap is. The last gap for Micron was, I believe, around 820. So I wouldn't want to see it come back into that gap quickly. We can all imagine that when this is resolved, it probably will be resolved in dramatic fashion. And yet we don't have any confirmed sell signals. That 20 days still pointing higher. So I understand why it's on people's radars, and the momentum is there.
Yeah, this is one, if you're so inclined to trade at these levels, look for ways to define your risk. Manage your trade size. As an options trader, this is where, finding reasonably priced call options and maybe selling an option against it to create a call spread, or selling, in this case, you could use this gap area potentially as a place to sell a put spread. When it's this far extended, just be careful. Like, don't just pile in, because eventually, when things go vertical, they tend to come back down with as much speed and velocity. So just manage your risk going in and define your risk relative to your account size. Don't be a hero. The last one, which kind of caught our eyes as well, that was a buy last week was Walmart. And that we just got through retail earnings, a very clear double top here around 135, and now we are testing the 200-day moving average. Talk to us about Walmart, Katie.
Well, we didn't like the reaction to earnings from this one, and you see the double top, of course. So that's effectively a failed test of that former resistance level. And now with a gap down like that, that looks a bit like a breakaway gap on the downside. With the breach of the 200-day now underway, I think we have multiple setbacks or sort of red flags on the chart here from more of an intermediate term perspective. It's probably going to bounce at some point here for maybe a better exit if folks were interested in reducing exposure. So I'm interested. I was very surprised, in fact, that there were a lot of buyers stepping in here because we just don't have, the positive catalyst right now from the chart.
Yeah, this is a tough one. A trader may look at this and try to buy this 200-day and trade it up to the bottom of the cloud. Investor, as you said, maybe looking for a better spot to get out. So always, multiple points of view to look at this depending on what your time frame is. Steph, we got three net sells last week. These were, you guys bring it up for me on the list. The top sales and notional: Palantir, United Health, Amazon. What is that telling you, Steph, from our customers' activity based on those? And we got AI, healthcare, and Amazon, which crosses so many different sort of classifications at this point.
It's actually like when I look at these every week, and it's actually not telling me very much, only because when you look at the amount of notional on the buy side versus the sell side, the signal is much stronger on the buy side this time around than I've seen in the past. Palantir has been a tough one to trade this year, I'd say, like ever since it kind of peaked, I think around November. It's probably starting to look a little more interesting, and I just wonder if that sale is almost like I'm done with this thing right when it starts to go back up again, just because the view of software is starting to change. And Palantir, I think, in some ways got caught up in that, along with the whole, pullback of the defense tech sector. The other two, these are very well-trotted names. Both United Health was a big buy, before, and Amazon kind of comes in and out. So it's probably telling you a bit less in the buy side.
Can we bring up the chart on this one, guys? Because this is a really interesting setup. So, Katie, I'm seeing what is pretty much a textbook head and shoulders. That created sort of the formation for the downturn. We broke through all the moving averages. The moving averages kind of, we've got a flat to downward sloping 200-day, which the stock is trading right at this moment. Back above the cloud, and now these shorter term moving averages trying to turn around. But when you have sort of a conflicted state here where maybe we've got a support level around 125, but we're clearly in a downtrend. We've got an overbought on the stochastic, but maybe the MACD starting to turn around. Like, is that a no-go for you? Is that like, how do you resolve some of the sort of conflicting signals that you see in this chart?
Well, we have to acknowledge that it would be a turnaround if you were looking to add exposure, that the breakout, it does appear to be a short-term breakout that's underway here, serves as actually a positive technical catalyst, but it is within the context of that weakened long-term momentum that you can see very much in the head and shoulders top that you identified, and also the slope of the 200-day. So it's conflicting on different time frames. So it doesn't mean that it's not tradable, but when you're trafficking in counter trend positions, they're just by their nature going to be a little higher risk. So for those that are, buyers and own Palantir, they might be more sensitive to downturn just by the nature of that loss of momentum. But I am surprised to see it heavier on the sell side with the rotation that we've seen of late. That was surprising to me.
Yeah. Interesting one. Whenever I look to put on a trade, I always ask myself, where am I getting out if I'm wrong? And if I'm going to trade Palantir from the short side, probably through options, that's maybe where you can give yourself a little cushion, sell a call spread above this 200-day moving average, define your risk. If you're wrong small, but if it does get a turnaround back to these lower moving averages or this range, it might sort of create that range-bound trade for a while. With that, guys,
I'm just thinking if you held it like around that head and shoulder area, and then you just kept it all the way down, you see this pop, you're probably like, oh, I just want to get out. That would be my explanation for sellers.
Yeah, and you know,
Good
that's, I
point.
think, you know, when you talk about like support and resistance, Katie, like it's not like some infallible law that like because a price traded here, it's because people have positions and they're positioning, you know, oh, maybe I get back to even, I'm going to get out, that's going to create
Yeah,
the resistance,
a
or
behavioral.
you know, gets back to the support, I'm going to buy more, and that creates the bounce. You know, there's always sort of the actual market story happening under these technicals. But guys, let's get some questions. I think we got some questions to get to. First one we got from Ann Horosky 4761. What is happening in rocket and space stocks? Steph, why don't you take that first?
I mean, I think it's just a lot of hype coming in with SpaceX. You know, the IPO that's coming, and it's bringing a lot more attention to just the whole area. It's something that's been part of a thematic that I've been watching for a little while, and I have to say that I think a lot. You know, if you take like a bigger step back in terms of the theme, space travel and space itself was well supported by the government in the 60s because we were in a race with Russia.
Yeah.
And this, and then that kind of continued into the 80s because of the Cold War. And then once the Cold War ended, we kind of started walking away from the whole program. And it's only just recently, I think, between SpaceX IPO, Blue Origin, that we saw the rocket blow up last week. You're just starting to see way more interest in this, and particularly, I think, because of the need for energy that we need on this planet, and where can we get it outside? How can we get closer to the sun? And should we put data centers on Mars? This kind of stuff is what's happening. If you read SpaceX's S1, Elon has a whole host of objectives that are around colonizing other planets. So I think that's what we're kind of back in a little race for space. Some of the most interesting companies that I have come around, because the technology does need to be upgraded because it kind of was left for dead after the 80s, that are private companies, but there are some in the public space that are moving. And so you've seen a bunch of ETFs actually get created around the theme too.
Yeah. I'm bringing up Rocket Lab here, RKLB. Yeah. Here's another one that kind of, moved to the upside and has started to come back down to earth, pun intended, trading near the 20-day. Here's a good example again, Katie, where like you've got these sort of confluence of indicators lining up. What do you like to look at in this space, and what are your thoughts on the upcoming IPOs that are bound to hit soon?
Yeah, I mean, as a technician, it's hard to have an opinion on IPOs, right? Because we have no, trading history. But with the existing public companies in this world, we've seen uptrends established, some newly established, and also these intermediate term breakouts that Rocket Labs is such a good example of. The breakouts did see follow through, and then last week's unfortunate news gave way to this pullback. The pullback, I think, should be welcomed by investors as an opportunity to add exposure into weakness. If you look at the stochastics on the daily chart, they're not oversold yet, so it would suggest that the pullback continues. But the breakout, I think, is the more dominant feature, and the long-term uptrend, and even the 20-day moving average, the pullback isn't a significant enough of a loss of momentum to translate to that 20-day. So I would just watch this pullback, see where it starts to show, that it has maybe more of a short-term oversold indication, and would be interested in revisiting this group.
Yeah, Rocket Lab riding that 200-day moving average once, twice, three times. And to your point, we got the down move to the 20-day, but we're not oversold yet on the stochastic. Next question from our favorite friend out in Hawaii, Mr. Esmond Archery, asks, what is the first indicator you look at of this group?
Yeah, I would actually not answer that directly by saying the first thing that we're looking for are the key levels. So we're looking for support and resistance first on the charts before we're consulting the indicators. But the indicators are going to help us understand if that support or resistance level is likely to hold or be achieved. But if I had to go to my deserted island, I usually say the weekly MACD indicator is going to be the one that I take with me, just because it's a good way to eliminate noise, identify the prevailing trends over sort of a very tradable time frame. And of course, trend following is really what we do. So I'd go with that one.
I love it. Nothing like a Gilligan's Island reference to start your day. Next question and last question from GCMX Vegeta. I don't know what to make of that. We'll just call it GC as in gold futures. What's your gold outlook? Seems to be following Bitcoin's up and down this year. Before you answer, Katie, like this is a trade that I think was in Steph's coffee cup tracing from January, a big part of the early part of the year story. Gold traded, I think it was up to almost 5,600 per ounce. Came all the way down to that 200. What a beautiful setup there, just tapping the 200 day at 4,100 and then trading back up. But here's one where the cloud and the moving average is sort of, I almost see a wedge forming here, Katie, where we have these upper indicators providing resistance, but the 200 day providing support. When you see that formation, how do you approach that? Like, what are you hoping to see in terms of a resolution when you have that sort of downward trending sort of wedge pattern?
Yeah, so we're calling this sort of a classic correction with the context of the long-term uptrend. And then the 200-day moving average is certainly acting as a support gauge. We have short-term oversold conditions turning higher, or the stochastics turning higher from oversold territory. So that suggests that even if the 200-day is penetrated briefly here, that it will be ultimately giving way to a good relief rally for gold. The catch is that the correction does reflect a loss of long-term momentum that's evident on the monthly chart of gold. So we don't think that this gold uptrend is going to resume in the same strong fashion that it has been trending higher over the last couple of years. So I do think there's been a little bit of a landscape change, but still open to a corrective low as an opportunity to add.
So the air's come out of the balloon, so to speak, but keep an eye at these levels. And he did bring up Bitcoin, so let's just bring up Bitcoin real quick. You know, I can tell we've charted this one in the past, so apologize all my levels and lines here. But in the crypto space, you know, where there's sort of the lack of the fundamentals to look at, and it's purely technical and narrative driven. How do you look at cryptocurrencies? How do you look at Bitcoin? What are maybe some caveats that you would provide to people out there that are relying on charts for things like crypto?
Well, I think that charts are incredibly reliable for crypto, and that it's a very pure supply-demand relationship for at least the more liquid coins like Bitcoin. And so it's very the pure relationship where it's just buying and selling and it's 24/7 actually makes for a really good chart with levels that are I'd say Bitcoin's very adherent to. So no risks in using the chart. In fact, I think the chart is something that will help you succeed and manage risk. We saw recently from Bitcoin an unsuccessful test of the 200-day moving average. Right now it's testing support at the daily cloud. You can see with an oversold indication there suggesting that it will hold or ultimately rebound. Bigger picture, it's just trying to work its way out of a corrective sort of long-term phase, more of a cyclical down move. But within that down move, we've certainly seen a loss of downside momentum that's meaningful.
Yeah, what a good point. You know, you see this and you'd be like, oh, it's time to get short Bitcoin, but you've got the oversold indicator here. It's sort of once again kind of makes you pump the brakes before putting on any position. But clearly a downward sloping 200-day moving average and this 75,000 level, which was a key level that we were looking at back from April of 2025, has been rejected once again. So we'll keep an eye on Bitcoin. But guys, this was fun. I had, you know, we've been wanting to get you on the show last month. We couldn't make it work, but we're so happy that you were able to join us today. Everyone in the chat, you guys did great. Hopefully you enjoyed the show. Steph, final word before we say goodbye as we go into the summer months and month of June. What's something we should be thinking about?
Doesn't feel like a sell in May and go away type of summer, but you know, September can often be pretty volatile, and I could see that coming to fruition. But also watch oil prices, watch them closely.
Final thoughts, Katie? Anything you want to leave us with?
Yeah, I would just pile in with the 20-day moving average. Let that be your friend. Once it rolls in general, it's a great indication of a time maybe you should go to the beach.
Yeah, or the golf course in my case, but
There you go.
fantastic. This was so much fun. Thank you again, Katie Stockton from Fairlead Strategies. Steph, as always, it's a pleasure seeing you on the stream. To all our friends in the chat, Edsmond, Philippe, Quantum, Luwak, and all the new viewers, always pleasure seeing you guys and hearing from you. We'll be back live probably the first week of July, but maybe we'll move that around because the 4th of July. So maybe a mid-month update once everyone gets back to their offices. Thank you, Steph. Thanks to all the folks behind the scenes that make the show possible. For Steph Guild, Katie Stockton, I'm Michael Obucina. Happy trading, everyone.